Okay, good morning. Today we are doing Chapter 2, and there are, just as a background here, well, let's do our thing and then I'll talk about Chapter 2 in a minute. Okay, so you should be in Learning Catalytics. There is a question out there. Right now, lots of you have it right, but let's go through it. Equity is $3,500, assets are $5,700. How much is total debt? Debt can be liabilities. The proper accounting term is liabilities, but we can ask about debt, and the two terms are kind of synonymous. Don't use dollar signs or commas in Learning Catalytics ever. So what we do to solve this is we're going to have the accounting equation, which is assets equal liabilities plus equity. You absolutely need to know the accounting equations. Okay, you're going to see it over and over. It's going to be throughout the semester. So what we're going to substitute in is what we know. We know assets are $5,700, liabilities are unknown, equity is $3,500. So then we can subtract $3,500 from both sides, and we get liabilities equal to $2,200. So that question is going to be open next for 2 minutes or so. I don't know when exactly it's going to close. So I'm going to leave it open. So if you're just joining us, you can get logged in and get your answer in. And it is $2,200. Again, you need to know the accounting equation. So it was last week's stuff, but it's going to be throughout the semester. So you need to know the accounting equation. Okay, just an administrative announcement before we go on. On Wednesday, February 3rd, in room 100, which is the room right below where, if you're in class physically right now, it's right below us, there's a Meet Your Major for just an hour. You learn about different majors, and they have some information about internships. So a lot packed into 1 hour, and it's also free pizza, and you get a t-shirt for going. So it might be a good thing to go. I'm sure you've gotten information about it, but they asked us to reiterate that this is available. I would go for a free t-shirt. So there's that. This Saturday, Chapter 2 homework is due in my accounting lab. So make sure you've done it. Remember, and I emailed some people yesterday, but remember that your homework, you can do it over the individual problems that you did get 100% on to get a better score. The expectation, I very seldom see people that do well in this class that don't get at least, I mean, we're talking down in, normally I see homework scores of at least 90% for people who get C's in this class. Okay, so it's not like, oh, I'm 70% of my homework, that's good enough. It's not good enough because you're going to see these problems on the exam. So work through them now. We go through a lot of them in class. I email out links for how-to videos on other ones we don't necessarily go over in class. So you really should be able to work through them. If you can't do them as homework, your prospects on the exam are not too good. So that's just, you might as well earn the score. Your homework and quizzes combined count as, I believe, 2 exams. So this is an opportunity for you to get the equivalent of close to 100% on the 2 items together. You should be logged into Learning Catalytics. I've got the session ID on several slides this week. Now, I emailed out people whose Learning Catalytics were going to expire yesterday or today, and you got that from me. Then there's, because it's a 14-day free trial, there's a slew of you who have expiring tomorrow or Wednesday, because of 14 days ago, that's about when class started. You need both Learning Catalytics and My Accounting Lab to get credit for class. And to pay for it, that's the #1 question I get. And I'm going to email out again, but to pay for it, the easiest way is to not in Blackboard, but outside Blackboard, go to pearsonmylab.com. Okay, it'll direct you. That's like a shortcut URL. So go to pearsonmylab.com. It'll direct you. Log in with your My Accounting Lab username and password, and then you'll see below our class name there'll be a little link for Upgrade Access Now, and you can do it that way. And I'm going to try to email you if you have an expiring account. I'm probably going to try to email you tomorrow if you're one of those people that will be affected Wednesday, because you don't want to come to class and go, oh my gosh, I don't have learning catalytics. How bad would that be to be here and not be able to get credit for it? So you just want to make sure it's current. You need learning catalytics and My Accounting Lab to get credit for class, because if you don't have My Accounting Lab, I have nowhere to upload it to. Okay, so Chapter 2. There are 3 fundamental chapters for the book. Things that will impact you the whole rest of the semester, chapters 1, 2, and 3. Those are huge. Spend extra time on these chapters up front. Hopefully your schedule isn't as crazy as it will be later in the semester. So work on these 3 chapters. Even though our final exam is not cumulative, the material that we cover affects everything else we do in the class. And of all the chapters, so chapters 1, 2, and 3 are the most important chapters. Of all the chapters, chapter 2 is the one that's just really, really important. If you can't get your way through 2, the rest of the class is going to be uphill. It's going to really, really be painful. So put the time in now because it'll pay off later. So what we're going to start with, chapter 2, we're analyzing transactions. And transactions, so in chapter 2, if you had accounting back in high school, this is not going to be as foreign sounding as otherwise. But transactions, when we talk about transactions, ultimately we're going to be talking about debits and credits and this lingo and understanding when we have a transaction, what's the impact on our business? Because you're going to probably be managers someday. You're going to be working in an organization, be responsible for various resources, and when you take an action, how does that impact your business? And a lot of you are going to be governed by bonuses. So when you do something, how does that impact your bonus? So that's why we want to understand transactions. So this chapter is about transactions, starting with what's a transaction, what accounts are impacted by transactions, and then on Wednesday we'll segue into the whole debit credit thing. If you had accounting in high school, this week and next week are probably the 2 weeks that cover what you did in high school. And if you didn't have accounting in high school, absolutely fine. This is geared for not having any prior experience. If you have prior experience, maybe it would be a little easier. But know that this is going to feel uncomfortable. Sometimes it's not going to make a lot of sense. I'm going to give you rules that apply. And after you play with it enough, pieces start falling into place. But in the beginning, it's going to be do this, kind of almost like I said so. I can describe why, but it takes a little while for that to work its way through. So we're going to get started. What's a transaction? Again, if you have the PowerPoint slides that I put on Blackboard, good, because they have a lot of what I'll be saying. I'm not putting all the slides up today, but they're all important. Those Blackboard PowerPoint slides have a lot of good information on them. So just know that those exist. A transaction is a financial event that can be measured, basically. So a transaction is a financial event that can be measured. When we talk about transactions in class, unless said otherwise, we're talking about the transaction from the standpoint of the business. Because you have the owner, okay, and the owner is in there in the background. But because of the entity assumption, we separate them. So we have the owner off there, but we're recording transactions. We're talking about the transaction from the standpoint of the business. Now, this is Whole Foods. We said that a transaction is a financial event that can be measured. Okay, so Whole Foods, here's some transactions they could have. They could purchase fresh produce. Okay, they're purchasing fresh produce. They can sell to customers. They can borrow money from the bank. They can pay the bank back. So those are lots of transactions. They are financial events. All of them involve dollars, and they can be measured. There's a purchase price. There's a loan amount. There's a sales receipt from the customer. So they can all be measured, and they're financial events. Now, transactions have 2 sides. Every transaction has 2 sides. We use something called double entry accounting. This has been in existence for several centuries. It's nothing new. So double entry accounting says for every transaction there's 2 sides. Roughly, You could say you get something and you give something up. So you receive something, you give something up, roughly. It works better on some transactions than others. In this case, Whole Foods purchases fresh produce. So Whole Foods is getting fresh produce and giving up cash. Sell product. Whole Food gives up their inventory and gets cash in exchange. Borrow money. Whole Foods gets cash and gives up their IOU on the other hand. Repay a loan, they give up cash and they reduce the amount that they owe the bank. They get their IOU back. So every single transaction we have in business, not just in this class, but in business, every single transaction has two sides. And we're going to spend a lot of the semester figuring out those two sides. Okay, so transactions have two sides, loosely, giving and receiving, loosely. Fits some better than others, but it's a way to think of it. And we will record both sides. So whenever we have transactions, when we ultimately do journal entries, every journal entry has two sides. Okay, so now we have a question. Which of the following business events, so these are business events, but not necessarily transactions, would not be recorded in the company's accounting records? Okay. Okay, so let's walk through these. Now we said a transaction. So transactions are what we record. So we're looking for the item here that is not a financial transaction. We said a transaction is a financial event that can be measured. Okay, first one, the company paid a monthly utility bill. So we paid a monthly utility bill. We handed over cash. That absolutely can be measured, and it impacts our financial situation. So it is A would be recorded. B, the company issued 100 shares of common stock. So if a company issues common stock, what they're doing is they're getting cash and they're giving up shares of ownership. So that is a financial transaction because it is a transaction. It's an event, a financial event, and it can be measured. There's a dollar amount that changes hands there. C, the company purchased 2 acres of land for future plant expansion. So we bought land. So we gave up cash and got land. That is a financial event because there's dollars involved, and yes, absolutely we can measure it. It happened. So C would be recorded as well. So now we get down to D. D, the company signed a contract to provide services in the next accounting period. Okay, this may very well be important to the company, but nothing happened financially. Nothing has happened yet. In the future, they're going to provide services and get revenue, but nothing has happened yet. They have signed a contract, but neither party has done anything, and nothing's changed hands. So the answer in this case is going to be D. So I'm going to close it in 5 seconds. By now you should have your answer in. Okay, next up now. Okay, so transactions. We've done with transactions. Now we're going to go to looking at accounts. Now, accounts are, the basic definition is it's a summary device. It's this way we have to keep track of what's going on in cash, what's going on in our equipment accounts. Basically, it's a record of all the changes in a particular asset, liability, or stockholders' equity during a period. So it's a record of how much customers owe us or how much cash we have. So if you think about your checking account, that's an account. Well, businesses have accounts. They're internal for every single item, and we're going to see that coming up in a moment. But basic definition is basic summary device. And again, we're kind of building it around the accounting equation. We have assets equal liabilities plus equity. Okay. Now, if you have the PowerPoint slides from Blackboard, there's several definitions, a lot of what I'm going to be saying now. But what you need right now, I'm going to go through 3 slides here. One's assets, one's liabilities, and one's stockholders' equity. Okay? And I'm going to have sample accounts on each of those. Now, we are going to have several questions today that takes a format of which of these is an asset, okay? So what that tells you is you need to write down these assets. Also, this is something absolutely positively you need to memorize. For our exams in here, I will provide you with a note sheet. That note sheet is stuff you don't need to memorize, and that note sheet is on Blackboard right now under Exam Info. I'm going to go quiet for a minute. I see a lot of pencils writing because I said you have to write this down. So I'm going to go quiet for a minute until I see people quit writing, and then I'm going to continue talking. So if you're online, no worries. You're not missing anything. Okay, so going back to what I was saying about the exam. On the exam, I'm just taking a detour for a moment talking about what you need to memorize and what you don't. On the exam, I provide you a sheet of things that you don't have to memorize. And some of those just give you a preview for this first exam are the debit credit rules. Actually, you have the debit credit rules the whole semester on your exam sheet. If you'd like to see what's on that exam reference sheet, it's on Blackboard under Exam Info. You can see exactly what you don't need to memorize. But in terms of what you do need to memorize, you need to memorize what's an asset, what's a liability, what's equity. Because when you're in business and you're talking, you have to know what an asset, liability, and equity account is. And this whole argument about, well, I could look it up. If you're having a conversation with your manager and you're talking about something, you need to know some basics. Just like if you go to the doctor, yeah, the doctor can look up all kinds of things, but if the doctor has to look up basic anatomy, you're going to have a little bit shaky feeling about having confidence in that person. Same thing. So there's some fundamental things that you're going to need to memorize, and this is one of them, okay? Knowing some basic assets, some basic liabilities, some basic equity accounts, being able to identify what kind of account something is. That's a fundamental concept. Again, you have some things that will be on your exam info sheet that you don't have to memorize. This is one of the things that you need to know. In addition, in a few minutes here, we're going to have questions that ask you things about this. Okay, so now hopefully you've got this written down, and I'm going to tell you some things about this. So these are sample assets. Assets are things that we own that are used in our business or somehow associated with our business. Now, on the first column, it's not random order. This is basically when we put assets on a balance sheet, the first thing we did this last week. The first thing listed is cash, and then down to things that aren't as liquid. So accounts receivable, close to cash, notes receivable, prepaid expenses, inventory, all of those are called current assets. They're things that are going to be used up or turn into cash within 12 months. So that's current assets. On the second column here, I've listed the longer term assets. So these are assets going to be around for more than 12 months. So that's just kind of where I split those two just for your purposes. So when you go to memorize them, you kind of know that those things that I put first are current assets. The things on the second column are longer term assets. This, by the way, these columns have nothing to do with debits or credits, left or right. It's just saying, here's a list of assets. And now I'm going to talk about those. Okay, so the first asset, cash. That's the most intuitive asset. We know what cash is. Cash is coins and currency, your checking account, your savings account, things that are just like cash. That's your cash account. It's always the first account listed on a balance sheet. Accounts receivable. Accounts receivable are amounts due us from our customers. Okay, so a customer comes in and buys something from us and says, I'll pay you in 30 days. Or we offer credit terms. We can get a lot more business if we offer some credit terms. So we offer credit terms. When you go to the doctor and you pay your copay, you've paid part of it, but then there's an IOU involved. That's accounts receivable for the doctor. Okay? So if the whole thing isn't paid at the time of service, the part that's not paid is accounts receivable. Accounts receivable always has to do with customers. So you might want to put a little line there. Accounts receivable has to do with customers. And you'll see why when we get to liabilities. Accounts receivable has to do with customers typically. Notes receivable is if we make someone a loan, typically cash. We loan them cash, that's notes receivable. And we're going to learn a lot more about this going forward into more different chapters. Okay, prepaid expenses. Prepaid expenses are expenses that we paid before we actually incur them. So an example, sometimes Progressive auto insurance is a good one. Progressive insurance, if you pay for your insurance a whole year in advance, they give you a pretty hefty discount, so you don't have to pay as much. So oftentimes businesses will take advantage of those discounts and pay their insurance, for example, a year in advance. So what they've done is they've paid for a year in advance, so it's called a prepaid expense, or in that case, prepaid insurance, and they have an asset. Why is an asset? It has future economic benefit. It provides us insurance coverage for each of those months. So that's a prepaid expense. There's another prepaid expense that doesn't have the word prepaid in it. It's called supplies. So you might want to jot that down. I don't have it written here. But there's an account called supplies. And supplies are things we've bought to use in our business in the future. We just haven't used them yet. So if we go out and buy 3 months worth of copy paper, so we bring back several of those boxes, that's supplies. It's just an account called supplies. It is technically a prepaid expense. It's considered a current asset because we're going to use it up. And then we have inventory. Inventory are items held for sale to our customers or that we use to make things into sale for our customers, but that's inventory. Okay, so that first column that we looked at, that's all current assets. So assets are things that we own. Current assets are turning into cash or being used up in the next 12 months. The next column over, the second column, are long-term assets. They're going to be around much longer. We have land. Land we bought, pretty self-explanatory. Buildings. Buildings and land are separate, and we'll see that when we get to Chapter 9 or something. One of those chapters coming up. Equipment, this is things like if we use drill press in our business or we have extruders or equipment. Furniture and fixtures, just what it sounds like. Fixtures are things like clothing racks if we're a retail store. And then other assets, which is just a big category. But we're going to add more assets than this as we go forward in the semester, but this is a good list to get started. Also, remember prepaid expenses. You might want to make a note that supplies is a prepaid expense, right? So that's another asset that's not listed. So there are more assets than this, but this is a good list to get started. So you may want to, this might be a good item to put on an index card and say, oh, I need to know these are the assets. Because there's certain fundamental information that will make life easier for you down the road if you know it. Okay, so those are assets. So we know that our accounting equation is assets equal liabilities plus equity. So now the next category, we have liabilities. And again, this is something you're going to see. It's something you want to write down right now because you're going to see questions about this coming up. So again, I'll pause for about a minute while I see writing, and then I'll resume. Again, if you're online, I'm just waiting for people to finish writing. Okay, liabilities. Again, I separated it into two columns just to kind of group them. That first column is our current liabilities, meaning due within 12 months. So current liabilities are the first column, and then long-term liabilities are in the second column, meaning they're due more than 12 months from now. So just starting at the top, accounts payable. Accounts payable has to do with our suppliers or vendors, and you may want to take a note. Remember back on assets, when we did assets, accounts receivable, I said had to do with our customers. Customers owe us. Accounts payable are items we owe. We owe our suppliers. We owe our vendors. So accounts payable, when you have to choose between accounts receivable and accounts payable, it depends. Is it our customer or is it our vendor? Okay, or supplier. So accounts payable is typically the first liability listed. This is when we're doing business-to-business transactions. We go down to OfficeMax, buy a whole bunch of copy paper, and they invoice us for it. We owe it later. So that is accounts payable. We have a debt. We owe OfficeMax. We have the paper, but we owe OfficeMax for the paper. Salaries payable. This is, you know how when you go to work for someplace, if you start, you might not get a paycheck for 3 or 4 weeks because they're running a couple weeks behind. That's salaries payable. That's amounts we owe our employees that have not yet been paid. It's been worked but not paid, because typically you don't get paid on Friday for Monday through Friday. You get paid for the week before or 2 weeks before. There's a lag time there. Okay, accrued liabilities are debts we have but we've not yet paid. An example is our electric bill comes from Ohio Edison. The electric bill's $100. It has a due date 2 weeks from now. So until the 2 weeks, that's accrued liability. It's an accrued utility expense, accrued utilities, because we haven't paid it yet. We absolutely owe it. We've used the item. We owe it, but we just haven't paid for it yet. Short-term notes payable. Short-term notes payable, that's we've gone to the bank and signed a loan. And this one, a short-term meaning is due in less than 12 months. And then current portion of long-term debt. Current portion of long-term debt it's just like what it sounds. We have a long-term debt. We have a 10-year loan. This is the amount the principal is due this year. Okay. Over in the long-term column, we have mortgages payable and long-term notes payable. Those are both what we would owe to the bank or other lender. Now, this next one, unearned revenue, really isn't long-term. It probably should be over here to be a current liability. Unearned revenue, this is something you need to start, because you're probably going to see 4 questions about this over the next couple weeks in class. Unearned revenue is a liability. What it is, it's a business that's collected cash but has not yet provided the goods or service. So here's an example. Kent Stage. Last week, Phil Vassar was at the Kent Stage. And the Kent Stage for 2 or 3, well actually 5 months ahead of time, sold tickets to see Phil Vassar. When Kent Stage sells a ticket to Phil Vassar, to any performance they have yet, that is not revenue to the Kent Stage. That is unearned revenue. That is a liability. The Kent Stage has a liability to put on that performance or to refund the money. So when any venue sells a ticket to an event, that is unearned revenue. That is not revenue to that company until the event occurs. If the event doesn't occur, they have to refund money. Now, other companies, other things that will be unearned revenue, airlines, when they sell you a plane ticket, that plane ticket is not revenue until the flight takes off, until the flight is completed. Then it's revenue. Until that time, it's unearned revenue, which is a liability. Another biggie, Starbucks sells more gift cards than any other company. Any company selling a gift card is unearned revenue, period. Okay? If they sell you a gift card, they have a liability to you to perform on that gift card. Now, a separate issue, not everyone will use all gift cards, so some of them go unused, and that's a legal matter. Sometimes companies need to send the unused gift card amounts to the state. The state will take it, or sometimes they recapture it, but it's beyond the scope of our class on unused gift cards. But suffice it to say, when you have a gift card to any company, that company has unearned revenue. So next time you buy a gift card, you can think, this is unearned revenue for that company, because until you use it, it is not revenue. So this liability called unearned revenue, it really doesn't look like a liability. That's why I want to call your attention to it, because you're probably going to have a question Wednesday that says, what kind of account is unearned revenue? The answer is liability. Basically with liabilities, if you see the word payable in an account name, chances are it's a liability. I cannot think of any account that has payable in its title that's not a liability. So that's one of those gimmies. You see liability, you see payable in the title, it's a liability. Okay, so those are liabilities. Now we get to the more confusing ones. So we've had assets, we've had liabilities, now we get to the one that's a little bit fuzzy. The next one is equity. Now, there's 2 types of equity accounts, and common stock and retained earnings. Common stock and retained earnings are equity accounts. So when we're talking about what kind of accounts are things, okay, equity accounts are common stock and retained earnings. Okay. And we're going to get some more accounts. Those aren't the only equity accounts, but those are the 2 of the major ones we're going to look at right now. Common stock is when we've issued stock to investors. If you see an account common stock, it is the company's own stock that they've issued. If a company buys stock in another company, it's an investment. It's called investment or something. But when you see common stock, those are the words that say this is an equity account. This is the company's own stock that it has issued. Okay, now I have these 3 accounts down here. So up to this point, we've had assets, we've had liabilities, and then we have these equity accounts, which are common stock and retained earnings. Those accounts that we talked about so far, assets, liabilities, common stock, and retained earnings, are all balance sheet accounts. So they all go on the balance sheet. Now, we have some income statement accounts which are revenues and expenses. So revenues and expenses are income statement accounts. And then that little one at the end there, dividends, that goes on the statement of retained earnings. We'll talk more about it. So revenues and expense are income statement accounts. But in general, revenues, expenses, and dividends all end up impacting retained earnings. Okay. And we're going to see some of that today, but the actual equity accounts are common stock and retained earnings. But we have revenues that increase retained earnings, expenses reduce retained earnings, and dividends reduce retained earnings. What we're going to do now is we're going to do some questions. And our questions have to do with equity accounts, with liabilities, and with assets. So you have all of that in front of you. So we're going to try a couple questions. Okay. So the first one is, which of the following is a liability account? This should be pretty easy. Okay, so on this one, okay, which of the following is a liability account? We have retained earnings, accrued liabilities, accounts receivable, prepaid expenses. This should be an easy question. Just look at those lists of liabilities you have. There is only one of these items on that list of liabilities you have. I'm going to close the question in about 10 seconds. Last opportunity to get your answer in. We have about 10 people who have not answered yet. That window is closing rapidly. Also, this I thought was a pretty straightforward question, right? You've got the notes in front of you. People pretty satisfied, pretty confident in your answers? I see a lot of people going, yeah, right? Right now we have 93% correct. So 7% must be your crowd, Amir. He's probably telling them all the wrong answers, right? Anyway, so, okay. Which of the following is a liability account? Okay. Okay, and it is accrued liabilities. Okay, accrued liabilities, those are things like the utility bill I haven't paid yet, I've gotten it, I owe it, just haven't paid it yet. Okay, retained earnings, let's just look through the other accounts just for fun. Retained earnings is an equity account. Accounts receivable has to do with our customers, and it's an asset. And then the last one, prepaid expenses, are an asset as well. Prepaid expenses are things like supplies that we buy to use in the business. You know how I said prepaid expenses, make a little note. Supplies are part of prepaid expenses. We could have prepaid insurance, we could have prepaid rent, and then we could just have plain old supplies, which are supplies we bought to use in the business, haven't used them up yet. Okay, so then next question. Okay, I have not delivered this yet intentionally. So goods purchased on account for future use in the business, such as supplies, right? Supplies are called what? So now I have delivered it. So supplies are a special type of what? Okay, the key on this question is goods purchased on account for future use in the business. That future use, we have not used these up. This is not running down to the store and buying a roll of paper towels. This is we're buying supplies for future use in the business, such as store supplies. Store supplies is actually an account. Special type are called, and let's talk about what things these aren't. Accrued liabilities has nothing to do with supplies. So we're talking about supplies. So the account supplies is not an accrued liability. The fact that we're going to use a future use in the business means that it can't be an expense right now. We haven't consumed it. We have not used it. So it can't be an expense. Revenue has absolutely nothing to do with this. So I'm closing the question in 10 seconds. Okay, so prepaid expenses, supplies are a type of prepaid expense. Future use in the business can't be an expense. Okay, next one. Okay, so I have not delivered this yet, but I do want to say this one should be the easiest. Let me make sure. This should be the easiest question you have all day today. All you have to do is look at your notes. So let's see. Okay, 100% on this one. Throwing you under the bus. Okay, right now, on this one, 83% are correct. Okay, so I'm sure, let's see. Okay, so if you want to get this right, go back to your notes just a little bit ago where we listed all the assets. All the assets are listed. As you go down through that list, there is one account on here that is not on the asset list. If you want to shortcut it, another way you could do this is look at your list of equity accounts. There are 2 equity accounts. One of those equity accounts is on this list and cannot be an asset. So confer with either one of those. Okay, we're up to 85% correct. So look at your notes. This should be the kind of question. You take notes as we go. This should be simple. So just future reference, you know, I tell you, we have to write this down. We have time to write it down. Again, you can answer this question by looking at the 2 types of equity accounts. One of those equity accounts is up here. That's the one that's not an asset. Okay, retained earnings is, of course, an equity account. Okay, so you really do need to know what assets are, what liabilities are, and what equity accounts are. That you will need for the entire semester, so you have it in front of you now. You should refer to it. The notes you take today will be extremely helpful on Wednesday and next week for sure. So make sure you bring these notes back with you, because I'm virtually certain that on Wednesday I'm going to ask you questions about, just like this one, which of the following accounts would be considered an asset, except which one, or which of the following is a liability. You need to recognize those accounts because your life will be so much easier if you can recognize types of accounts. And it's just one of those things like basic anatomy you need to know. Okay, one more question before we go on. Any event that has a financial impact on the business and can be measured reliably is what? Okay, get your answer in. This one, of course, is a transaction. I'm going to close the question in about 10 seconds, and then we'll go on to the next learning objective. Okay, so we've gone through what a transaction is, basic types of accounts, and now we're going to start analyzing transactions. So today we're not doing debits or credits, but what we're going to be doing is we're going to look at a transaction. We said that every transaction has two sides. So now we're going to be looking at those two sides and saying what's happening in the transaction. So we're going to do this by an example. So the example, not necessary to write this down, it is in the PowerPoint notes. Not necessary to write this slide down, but yes, the next slide. Okay, so we have a doctor opened a medical practice this first month. So no operations prior to this first month that we opened. So we're going to have a bunch of events. Now, what you need to write down, because this is the example, we have a series of headings. What we're given is we're given a column for the date, so that's good to be able to reference things, but then we're given 4 columns for assets. We're given cash, accounts receivable, medical supplies, and land. Those are the assets of this business we will need. How do we know it's only those 4? It's because I know what transactions we're doing. The business would have more than 4 asset accounts, but for our purposes here, to keep this manageable so we don't have, 50 columns, we have 4 assets we'll be using, period. So I'm telling you what those are. So we have cash, accounts receivable, medical supplies, and land. Those are our assets. So then you see an equal sign. So we have cash plus accounts receivable plus medical supplies plus land. Those are our assets. Now the next 2 columns over are our liabilities. We have accounts payable and notes payable. Okay? And then the last 2 columns, common stock and retained earnings. And those are stockholders' equity. So our columns are set up in the format assets equal liabilities plus equity. We're only using a total of 8 accounts for this exercise just because that's what we're doing. We don't want to make this super complex on our first trip through. You're going to have several rows below this. So we're going to record each transaction on a row. We probably have 8 or 10 rows, I think. So what we're going to be doing on this, what we're going to be doing on this then, we have those headings, and what we're going to be doing is we're going to be analyzing the transactions. And the transactions are going to be listed up here. So this is our first transaction. Okay. So remember, this business is just starting business now. So there's nothing in the past that we need to worry about. We're just starting. So the first transaction, so I'm assuming you have all your columns set up. So you have your 4 asset columns, you have 2 liabilities, 2 equity. Why these 8 accounts? Because that's what this problem uses. This is set up for us. So the first transaction is Dr. Luke invested $100,000 in the business in return for common stock. Now we are doing all the accounting in this class from the standpoint of the business. So from the business standpoint, what's happening? We have a transaction here. It's a financial event, and it can be measured. It can be measured because it's $100,000. So what happened? Well, the business received $100,000 cash, and the business gave $100,000 of common stock. So what's happening here is we have $100,000 increasing cash, and we have $100,000 increasing common stock. Okay, so now we've issued $100,000 of common stock, and we've gotten cash in return for it. Okay, so that's our first transaction. Now, if we were to stop right now and do the accounting equation for this business, we would have assets equal liabilities plus equity. Our assets would total $100,000. Our liabilities and equity would total $100,000 even also. So our accounting equation balances. After every single transaction, our accounting equation will balance. So right now it's $100,000 equal to $100,000. So our next transaction's coming up, and our next transaction is the business borrowed $50,000 signing a note payable to the bank. Okay, so the business borrowed $50,000 signing a note payable to the bank. So what happened? The business received $50,000 cash. It went to the bank and borrowed $50,000. So cash is going to be going up by $50,000, and the note payable, it says right in the title, in the description, note payable, now the business has a liability for $50,000. So we're going to see cash go up by $50,000 and notes payable go up by $50,000. If we were going to stop right here and do our accounting equation again, we would have assets equal to $150,000 equal liabilities plus equity of $150,000. So we're still in balance. We will be in balance after every single transaction. Every transaction has to have two sides. Next transaction. Next transaction. The business paid cash for land costing $105,000. Okay, and it says Luz plans to build an office building on the land. So what's happening here? The business paid $105,000. So cash is going down, and in return, the business is getting land. So land is going up. Now, so we have cash going out. Cash going out is a negative $50,000. We put parentheses around it to denote that it's negative. For $105,000, sorry. $105,000, negative $105,000 because we're spending $105,000 on this land, and land is going up. So we're giving out cash, getting land, and there's our transaction. Now note that our assets didn't change in that transaction. We just shifted. We shifted $105,000 out of cash into land, but overall assets don't change. And our accounting equation would still be in balance. Okay, next transaction we have. The business purchased medical supplies for $1,700 on account. Okay, so one side of this, we purchased what? We purchased medical supplies. We have a column for medical supplies, so we're going to put $1,700 in that column. Now, we've got magic words here, on account. If you see the words on account together, the phrase on account, that means it has to do with either accounts receivable or accounts payable. Accounts receivable has to do with our customers. Accounts payable has to do with our vendors or suppliers. So in this case, we purchased medical supplies on account. We purchased them from our supplier. So this other side of this has to be accounts payable. What we're doing here is we're getting the medical supplies, and we're also promising to pay at a later date for them. So that's going to be accounts payable. So what we're going to see is we're going to see medical supplies go up by $1,700, and we're going to see accounts payable or liabilities increased by $1,700 as well. And if we were to add up the first 4 columns right now, it would equal the second 4 as well. So our assets still equal our liabilities and equity. In any given row, assets will equal liabilities and equity. Okay, next item. Dr. Luke officially opened for business on February 12th. Well, that's nice. That's something you would write on your calendar, certainly. You would write it down somewhere. But that is not a transaction because it's not a financial event, and you can't measure it. We opened for business. Okay, well, that's nice. Write it down somewhere that you did, but it is not a transaction, so there's no entry on February 12th. Okay, so not everything is a financial transaction. February 14th, Dr. Luke treated patients and earned service revenue of $5,600, receiving cash for half the revenue earned. Okay, so what happens here? You know when you go to the doctor, so this is going to be a simplified version of that. But you go to the doctor and you'll pay a copay, you'll pay a certain amount, and then you or your insurance company get billed for the rest. That's what's going on here. We just made the math really easy. So what happens is Dr. Luke performed services for $5,600 on this day. That's it. So we have service revenue of $5,600. Service revenue increases retained earnings. So we're going to stick service revenues out there in that retained earnings column. So service revenue increases retained earnings because back to our equity accounts, we said we had common stock, we had retained earnings, and then retained earnings was increased by revenues, decreased by expenses, and also decreased by dividends. So we have service revenue earned here. Now, we have service revenue on the other hand. So we have one side, we've earned revenue. The other side, we've received cash for $2,800. So those were the patients that paid as they came in. So we got cash of $2,800. So we're going to see cash go up by $2,800. And then the other $2,800 is the billed to insurance companies or billed to patients. So that's going to be accounts receivable. We know it's accounts receivable because it's our customers. Patients are customers as well. So what we're going to see, cash go up by $2,800, accounts receivable go up by $2,800 for the portion they haven't paid yet, and then service revenue is the $5,600. We're out there in the retained earnings column because revenue increases retained earnings and expenses decrease retained earnings. Next, business paid employee salaries at $2,300 for the first half of the month. We paid employee salaries. We have cash going out, so cash is going to decrease, and salaries expense is going to reduce retained earnings. Next item. Dr. Luke treated patients and received $1,500 cash at the time of service. That's easy. We got cash, so cash is going up. We treated patients, so service revenue is going up as well. So we'll see $1,500 in the cash column and $1,500 out in the retained earnings column. Next transaction, the business paid office rent of $1,000. So we paid. Whenever you say paid, it implies that we're paying cash. So cash is going to go down by $1,000, and office rent is an expense, so we're going to reduce retained earnings for the rent expense. So again, two sides. We're paying for cash, and we're reducing, ultimately reducing retained earnings for that expense. And then our final transaction, the business paid $500 on account. So paid $500, that's the easy one. So cash went down by $500. Now on account means one of two accounts. If you see on account, It's going to be accounts receivable or accounts payable. So back to our rule, accounts receivable has to do with our patients. Would we be paying our patients? No. We would be paying our suppliers or vendors, so that has to be accounts payable. So what we're going to see here is cash is going down by $500, and when we pay on account, we're paying off some of what we owe. Okay, so we're reducing what we owe. Now what we'll do, because that's all the transactions we have, what we're going to do now is we're going to add every column up. So we're going to have total cash, we're going to have total accounts receivable. All the columns are easy except the first one and the last one, but I can do it with one click. So what we've got, if I add all the numbers in the cash column, I will get $45,500. If then accounts receivable, $2,800, medical supplies, $1,700, land, $105. Accounts payable, we have the balance of $1,700 minus the $500, so it's $1,200. Notes payable, $50,000. Common stock, $100,000. Retained earnings, we add the service revenue, subtract the expenses, and we end up with $3,800. Then we can add our first four columns together. Those are our assets. We get $155,000. We can add the last four because those are two liability columns, two equity accounts. We add those together. We have $155,000. So our accounting equation is correct. We have done the proper increases and decreases because our accounting equation always has to balance. Now what we're going to do is we're going to answer a series of questions on this table. So I'm leaving the table up here. The only thing that's going to disappear maybe are the $155,000, but the little totals are going to stay. So we're going to answer a series of questions about this table. Okay, first question up there at the top. What are total assets? Well, total assets are the four columns added together. So total assets, $155,000. So that's what the business owns. The business owns $155,000. Next question is, how much does the business expect to collect from patients? What the business expects to collect from patients is called accounts receivable, so that's accounts receivable total. That's it. Okay, next question. How much does the business owe in total? So now we're talking about the business debts, the total liabilities. Well, what we're going to do there is add the liabilities together. Accounts payable totals $1,200 plus notes payable of $50,000 gives us total liabilities of $51,700. Okay, two more questions on this. The next one is, how much of the business's assets does Luke really own? Here it's asking for the equity of the business. What is the equity of the business? That's adding those last two columns together, common stock plus retained earnings together. So that's $103,800. Now, for the last question, how much net income or net loss? The only reason the answer is $3,800. It's not, net income is not retained earnings. They are not the same thing. The only reason that this will work in this case is because the business just started, so there was no beginning balance and there were no dividends. But net income is revenues minus expenses, which is exactly what we have in that column. We have revenue of $5,600 minus the expenses and then another revenue of $1,500. So revenues minus expenses is net income. Okay, what we're going to do right now is we're going to do a homework problem that's very related to what we just did. This is also one of the homework problems. It's really short, but I get more questions about one little thing in this homework problem than most other homework problems. So what we have is we have Kathy's catering began with cash of $15,000. Kathy then bought supplies for $4,400 on account, and separately Kathy paid $7,500 for equipment. Okay, so we have those little scenarios there. We have a beginning balance, and we have two transactions is what we're given. So in A, how much in total assets does Kathy have? B is how much in liabilities. That's all we're being asked. How much in total assets? How much in total liabilities? So we're interested in this problem in only assets and only liabilities. So the first transaction, we don't have a first transaction. We have assets as our beginning balance because they want to know our total assets. So we started with $15,000. That's our beginning cash balance, so make a note of that. We'll have $15,000 off to the side somewhere. Okay, our next transaction. Kathy then bought supplies for $4,400 on account. What happens when we buy supplies? Well, we have an asset go up, supplies. So we see assets go up. So we have $4,400 assets increase. So if you have a running total, I would put a column right now of assets. Okay, so you start your column with $15,000, and now you have a plus $4,400 for supplies. And they have a column off to the side for liabilities because we just also increased liabilities by $4,400. When we buy supplies on account, we're increasing supplies, which is an asset, and we're increasing accounts payable, which is a liability. So we increased, so far we have cash, $15,000 plus $4,400 for supplies. That's where we are on assets. Liabilities, we have $4,400. Okay, we have one more transaction here. Separately, Kathy paid $7,500 for equipment. Okay, if I paid $7,500 for equipment, what's happening here is equipment's increasing. I'm getting equipment for $7,500. And this is where the big question comes in. Everyone always forgets, I get equipment for $7,500, but I also pay cash for it. So my assets in this last transaction, cash goes down, equipment goes up. Those are both assets. So one goes up, one goes down. They kind of cancel each other out in effect. Right? Because we paid. We had cash go down, equipment go up. They're both assets. So when we're answering the question, how much in total assets does Kathy have? The answer for that is going to be $19,400. How'd I get it? Beginning cash balance of $15,000. The supplies I bought, $4,400. The equipment I bought of $7,500 minus, here's the kicker, minus cash that I paid for the equipment of $7,500. That is the single biggest thing that people forget to do is take out the cash we paid. We can have a transaction where one asset goes up and another one goes down. That's perfectly fine. Okay. And then how much in liabilities does Kathy owe? That answer is simply $4,400. That was the only Okay, so when you do this homework problem, make sure, going back here for a minute, make sure you subtract out the cash. Because there's a tendency to go, oh, we had cash to begin with, we bought equipment, so that went up, and then we got we bought supplies, that went up, and then we got equipment, but people forget to subtract the cash we paid for the equipment in the second transaction. Okay. Okay, so now we have question 12, and okay, so I have not put this out there yet, so you don't have it yet. Which of the following transactions will increase one asset and decrease another one? Okay, so we're looking for a transaction that has two assets. So all we need to do for each of these is identify what two accounts are in the transaction. So for A, the purchase of office supplies on account. Supplies is an asset. On account, if we purchase supplies, that is not a customer, it has to be accounts payable. So we've got an asset and we have a liability for A. B, the performance of services on account. So services is service revenue. That's an equity account. So it can't be B. Okay, so you see, we're looking for an account. We're looking for a transaction that has two assets. So as soon as we find something that's not an asset, we don't need to do it. So it's not B. The purchase of equipment. Equipment is an asset. Cash is an asset. D, the performance of services. When we perform service, that's service revenue, which is an equity account, and cash is an asset. So hopefully, let's see. This is 12. Okay, so now you should have it. Again, you're looking for the one thing, the one item there that is only assets. So when we talk about A, for example, office supplies on account, that accounts payable is involved, accounts payable is a liability. When we talk about B, performance of services, when we perform services, that's service revenue, which is an equity account. For D, the performance of services, again, performance of services is an equity account, and the problem is asking, the question is asking, which one of those items is all just assets? Which items are both assets? So I just identified that A has a liability in it, B has an equity and a liability, B has a service, which is an equity and an asset. C is two assets, and D, performance of services for cash, would be an equity and an asset. I'm going to close this in about 10 seconds, so you want to make sure you get your answer in. I have about 25 people who've not answered, so your time is dwindling rapidly here. Okay, it was obviously purchase of equipment for cash, two assets. Okay, so it's 1 minute left, so I guess we're not going to start anything new. So I will see you on Wednesday, and if you're one of the expiring My Accounting Lab Learning Catalytics, get that renewed before Wednesday. Bye online.